Okay.
Good
Hello,
morning, and
everybody.
thank you for joining us for today's free webinar, Creating a Business Financial Plan Investors Will Love, with Sirk Rowe and Steve Olson, partners and CFOs at Early Growth Financial Services. My name is Jenna Cornell, and I'll be your moderator for today's webinar. This presentation will run about 40 minutes. If you have questions as we go through the presentation, feel free to enter them in the question field or tweet them mentioning at Early Growth FS or using the hashtag InvestorLove. We will answer questions as they come, if we can, or we'll wait until the Q&A at the end to address them. If we run out of time, we'll follow up with an email after the presentation to make sure all of your questions have been answered. The video for the webinar will be available on our YouTube channel following the presentation, and the slides are available on SlideShare. The links to both of these will be sent to you following the presentation. Sirk and Steve have a lot to cover today. We want to make sure we have time to answer all your individual questions. So let's get started. Good morning, Sirk and Steve.
Good morning, everyone.
Good morning. Thank you, Jenna. Okay, so creating a business financial plan that investors will love. Um, so just as a bit of a background here, Sirk and I are, as Jenna mentioned, are partners with Early Growth Financial Services. We provide outsourced financial services for several different startups and mid-sized companies, we kind of provide a full back office solution for all your financial and accounting needs. Um, Basically, the foundation of that is four platforms of service: your day-to-day transactional accounting, your more strategic advice and CFO input, tax compliance, and we also have a valuation practice for companies that require valuation work if you're issuing options and things like that. On the specific services side, we'll handle everything from your accounts payable, receivable, your forecast, cash management, your monthly close with supporting schedules, again, tax compliance, 409A valuations. Again, that's a requirement if you're issuing stock options. We have several clients, over 300 plus clients nationwide. We have primary footprints in San Francisco Bay Area, obviously, LA, New York City, Boulder, Austin,
Jenna
Chicago.
and Deborah are doing a webinar right now, so they won't be joining us. So I just was going to talk about that one thing that we emailed about, and then I'll jump off and you guys can just have your sales call.
It sounds like
I mean, just the one thing I want to say is, again, I'm ever hopeful that these contact us forms are just going to keep getting filled in. We're going to get more and more leads through them, and so
Hey, Erica.
Amanda is now, as part of her process, whenever she gets one of these leads from the contact us form, that she forwarded on.
I'm sorry, we had some background conversations going on there, it sounds like. In any event, so we have a nationwide footprint in most of the major cities where there's a large startup ecosystem. And we just happen to be awarded the number 5 fastest growing private company in 2013. That would be in Silicon Valley. Okay, moving on. I seem to have lost control of the slides. Jenna? There we go. Sorry. So we're talking about building your financial projections, your financial model. And this is really supporting the story that you're telling your investors. It starts with that, and your financial projections are a key supporting piece of this, and it's an opportunity for you to really define your business and your business model in more quantitative elements, obviously. And, key to that is, what your investors are going to want to know is, they're going to be interested in, your revenue growth rate, your cash flow primarily, and how quickly you're going to get there. Obviously, they're looking for a return on investment. That's going to be critical to whether or not, you're going to get investment from it. Okay, can we move on to the next slide? Thanks. So this presentation will touch on several different areas. What are your investors looking for? I mean, you're creating a financial model not only for your investors but for yourself. So it'll help you think about your business, and it'll help you plan, and it will help you manage your business, because you can use this as the foundation for your management budget going forward. What is a financial model? Part of how do you go about setting your goals and objectives? Milestone funding, which is fairly typical nowadays. Your business model may require a certain level of investment over 3 or 4 years, but you're not going to get all that up front. Typically, you'll get a piece of it now, and you'll have to get another piece of it down the road. And that's usually based on how you've achieved certain milestones that are in your plan. We're going to look at bottom-up financial projections, look at spending, budgeting, talk about top-down projections, and then cost assumptions, and the process of forecasting, reforecasting. Once you've done your original plan, what do you do with it? You typically want to reforecast that on a periodic basis. Okay. Why do you need a 3-year financial model? 2 reasons I mentioned up front. It's a requirement for outside investment. They're going to want to see more detail about how you think about the business, and what it can mean for them from an investment perspective. You're also going to want to use it to manage your business and to measure yourself. Very key element in this whole process is understanding your cash burn. You really don't know how much money you need until you sit down and think about how your business is going to operate over the next 1 to 2 to 3 years. And without taking that quantitative, detailed look, your investor is going to ask you, well, how do you know? You need $1 million, or you need $2 million. And what are you going to use that for? So you really need to be very rigorous in terms of thinking about your assumptions and validating your assumptions to the extent you can, at least making sure that they're rational and that you can demonstrate that you can clearly demonstrate that that your assumptions make sense, right? That they have a basis in reality.
Steve, do you mind speaking up a little more? Some of our attendees are having trouble hearing you.
Sure. I apologize. It'll help you put your challenges into perspective, right? You're going to have several different things you're going to need to achieve. This can also help you figure out which ones are higher priority. It should be an iterative process, and it will be something you'll constantly tune and change, and it shouldn't be something that gets built and then put on a shelf. You should be reviewing your plan and your financial projections on some regular basis, whether or not that's monthly, quarterly, semi-annually. but it should be used and measured again, remeasured, and changed as you go forward, because you're going to learn. It's going to allow you to get some insights into your business model, because when you start thinking about your business model and you start trying to detail it, put it into a financial context, you're going to realize, oh yeah, I need to think about this, or I need to think, this particular cost is not going to be fixed, it's going to be variable, and I need to figure out how to allow for that in my model. It's going to help you clarify decision-making process, both short and long term, because you're going to be guiding your decisions around your projections, which you should be. It'll also give you leverage in terms of a baseline valuation, in terms of thinking about where your company is going to be valued and what you want to achieve out of any investment. Okay, next slide. All right, what goes into your 3-year financial model? Again, this is kind of high level, but and it probably is not going to be a huge surprise to anybody. But you want to really start out with your major objectives. What are you trying to achieve, right? And then from there, what are the steps and the key milestones along the way? Is it product delivery? Is it sales performance? Is it if you had an acquisition strategy? Those are pretty key milestones that you'd want to incorporate into this very specifically. Key assumptions. Assumptions around sales production, potentially. How productive are your salespeople going to be? That's a very key element in your planning process. In fact, the whole sales modeling is probably the most complicated and where you end up spending most of your time. So you end up having an inordinate amount of key assumptions in that area, from sales production to cost elements of service delivery. Trending analysis could be related to what you expect is going to happen in the market, or trending around costs. The key variables that you're going to want to track in your model, and obviously the timeline, because this is all based on time. When you build a 3-year financial model, and when we talk about a financial model, in the best case, you're talking about a pretty detailed, a level of detail that rolls up to regular financial statements. A P&L, a balance sheet, and a cash flow statement. And you can do that monthly, quarterly, annually. You can have summaries that roll up into those different time frames, but that is in the best case. But the detail can be several different iterations and schedules below that you can really drill down on if you need to. Okay, next slide, please.
Can you elaborate more on trending analysis?
Yeah, so this could mean several different things. It could mean if you're doing a top-down, if you're building a top-down business model, when you're starting with your market, you may have certain growth assumptions, or you may have certain market information and projections of your market growth from other third parties that you could use in building your own financial model, and assumptions around your own financial model. You can also have cost analysis. what's happening with labor costs in the Bay Area. You know, what are you paying for a software engineer today versus, you know, what are your assumptions about 12 months from now? Salary inflation is a key thing to consider when you're building a financial model if your business is based in the Bay Area. Does that answer the question? I hope it does. Other questions for Jenna? Okay. All right. Identify major objectives for your company and what do you want to achieve? And again, depending on where you are, where your company is, are you expecting to burn cash over the the next 3 years? Are you expecting to be profitable? Are you expecting to be generating cash? You can be profitable and not generate cash, and you can generate cash and not be profitable. So there's a lot of different, and it really depends on your business model. But identifying what you're trying to accomplish, right? With the model, if you're building a model primarily for investors, then you're going to want to lay out a picture that shows them, you know, this is my business model. I need this amount of investment at this time, and I'm going to need some additional investment, 18 months down the road. And you're laying out story and setting the expectation with your investors that, okay, I need this much now, and I'm going to need this much later because this is how I'm going to grow my business, and it's going to require more cash. If you're throwing off cash, if your business is actually generating cash, your investors are going to want to know what you're going to do with that, right? Are you going to reinvest it into the business in terms of staff, in terms of marketing activities? Are you going to potentially look at acquiring either companies or other products that become part of your offering? Those are all things you need to consider and model into your plan so that your investors have a very clear picture about what you're doing and what it's going to look like financially. Okay, next slide. I think, Sirk, you're going to pick it up here.
I am. Thanks, Steve. That was a great overview, high level, all the things that we need to be thinking about as we're putting together a financial plan. Hi, everyone. My name is Sirk Rowe, and as Jenna has mentioned, I am a partner and CFO with Early Growth. And so while Steve was able to focus on some of the higher level things that we need to consider as we're putting together a financial plan, I'll kind of get into maybe a little bit more of the nuts and bolts and details of what actually we have to put into the plan to make sure that it's appropriate for the business that we're trying to analyze. And so, Steve hit upon some really, really good points, especially with that last slide, where we have different scenarios depending on the stage of the company, right? We may be an early stage venture back or looking for venture backing company for a company that doesn't have revenue yet, doesn't have product, and is developing product or is developing a service, and we need cash to fund our development. We may be in a position where we are actually throwing off some revenue, and we may be getting up to cash flow break even, or we may be getting up to profitability. And in fact, Steve indicated a couple of different scenarios where we might actually be profitable but using cash. We may actually not be profitable from a P&L or income statement perspective, but actually have positive cash flow. And all of those things are different types of scenarios depending on different businesses that we have to consider. And really, it's the process of preparing an appropriate financial plan that will spell that out. And we as managers of the company will be able to run our business that way, and we as executives and CEOs of the company will be able to take that plan and go out to investors and tell the story of what we're trying to do and why we need the money to get us to the next milestone, so that we can have a higher value company in the next round. And so with that as the background, let's kind of talk about what we actually have to do to create your financial model. And again, we are at different stages. Some companies may be very, very early stage. It may just be a CEO. It may be a CEO and a technical founder, where the CEO might be, he may be a technical guy already, and maybe he's partnering up with a sales and marketing person, a business person, or it just may be a CEO and just really trying to get both sides of the business started on both the product development and and thinking about the marketing of the company going forward. But in any case, we have to go to all the stakeholders, and we have to go to the members of the executive team, and we have to talk through kind of what we're trying to achieve. Where are we in terms of product development? When do we expect revenue to hit? What strategic decisions do we need to be making about partnerships and hiring and different ways that the product development might go? And then look at all that information and try to figure out okay, how much money do we need to get us to the next milestone? And we'll talk about milestone funding and milestone planning in more detail, because I think that's kind of the cornerstone of the way that we would approach financial modeling, which is to look at kind of what are the big milestones that we're trying to achieve and how much money do we need to get there. And as part of this, you're going to go into a lot of dialogue. You're going to go into a lot of trade-offs. Obviously, a product development manager is going to want certain resources and cash allotted so that he or she can make sure that he or she can meet all the milestones from a product development. Obviously, if you're talking with a sales and marketing team, they're going to go through, as Steve mentioned, kind of the metrics, right? Of okay, this is the kind of revenue projection that we have. We think we can achieve it, but in order to achieve those revenue milestones, I'm going to need this kind of a sales team and business development team and marketing team in place for us to be able to achieve that. And it may be very, very different than what a CEO or a technical founder might be thinking about in terms of what is needed from a corporate perspective. So all of that dialogue then is going to be used to create a bottom-up forecasting and a bottom-up budget, so that everyone is aligned with how much money is needed, where is that money going to be put to use, how many resources are we going to be adding from a software perspective, hardware perspective, and hiring and then other types of sales and marketing and G&A type of spending. So let's talk about kind of this bottom-up financial projection, where we start with what we need to be achieving from a revenue perspective and a product development perspective. And this is not only from the amount of revenue, but also when we expect to see that revenue start to hit, or start to hit that inflection point where there's going to be big growth. Because in order to achieve that, we have to have everything up front, both from a product development standpoint as well as a staffing standpoint and a sales and marketing standpoint. Otherwise, we're not. Otherwise, it's just a pipe dream, right? We could say that we're going to have revenue growing X percent per year exponentially, but unless we really have a plan to be able to support that and to be able to grow that, it's just a pipe dream. And so that gets us to the second point, which is obviously calculating the spending that is necessary to achieve that revenue and the development. And this is kind of where we go to the back and forth between all the team members of the executive team, making sure that we get the inputs from them to really ferret out all the assumptions in the model that is going to make us be successful in reaching our goals. And then from that is going to basically filter out, what kind of headcount we're going to need. Where are we going to need it? What are those titles of those people are going to be? How many software engineers are we going to need? how many salespeople, how many marketing people, how many customer service people, if it's a service, or if there's a service component of our product or offer. And then all that kind of gets us to, okay, let's think about all of the spending that we're going to be doing. So what kind of customers are we going after? Is it a B2B model? Is it, or a business to business model? Is it a business to consumer model? How do we go about acquiring those customers? Is it a very, very hands-on approach, a high-touch approach, as we like to call it, where a salesperson really has to go out and meet and shake the hands of our customers? Or is it something that's going to be, just purely an internet play where we're going to be able to drive exponential growth from headcount and from being able to sell our services through advertising or what have you? So every business and every company is going to have a different model, and the way that they go about acquiring those customers and the amount of cost that it takes to acquire those customers is going to be different, and we need to think through that. The human resource cost is obviously a huge one for most companies, right? Whether it's in product development mode and we need to be hiring software engineers or programmers, whether if it's manufacturing, there's a high human resource cost. If it's in consulting or in service, there's a high human resource cost. Getting that number down right in terms of both the number of people and the level of people, so the title level, which obviously equates to salary levels, is critical to I would say the accuracy of a financial plan. And I think that this is probably one area where the bulk of the discussion should take place, in making sure that everyone is aligned, that we've got the right people coming in at the right time. And that's also going to be another critical thing too, because as we go through the back and forth, I think there have been times when I've seen, for example, where doing kind of a bottoms up, we say, okay, well, we need to hire 2 software engineers per month for the next 12 months. Well, that may sound good when you look at it at a high level, but then when you really look at it, think about kind of what it would actually take and the amount of bandwidth that it takes to actually hire that type of resources, then you maybe realize that that's not necessarily practical. And then you need to rethink those assumptions and maybe edit the higher level assumptions that requires adding that many people on staff at that quick of a speed. You need to look at consulting and professional services. There are going to be times when you're not necessarily going to want to hire everyone in-house. And in fact, I'll put a little plug in here for early growth that says that services like financial outsourcing and services like HR outsourcing, and to a certain extent, even some sales and marketing services can be outsourced to professionals, and allow you to be able to use those services on an as-needed basis instead of hiring full-time people. Obviously, research and development is a big key. Don't forget about office and admin costs, and especially if you're a company that is, in the kind of the high growth internet space, the type of spending that you have to do to acquire top talent, not only from a salary perspective, but even just kind of, additional spending, right? The morale, the culture of the company and what it takes, to have, maybe you're a company that wants to incent our employees to be able to work really, really long hours. And as part of that, you offer things like, gym services and you offer free food, lunches and dinners in the office so that, again, employees are incented to stay and work long hours, and feel like they're being taken care of while they're doing that. So those types of expenses you need to consider. Sales and marketing, obviously, I think nothing more needs to be added other than just making sure, again, that you talk to our sales and marketing team, because as a CEO, as a founder, it's very, very easy to put a high-level assumption about kind of, okay, well, I'm going to put in, X percentage of the revenue is going to go towards sales and marketing, both in terms of commissions and salaries. And that may work at the very beginning, but then when you really dig down, a lot of times what you find is that a sales team is only going to be effective when they have enough resources to achieve the goals, corporate goals, and that those that amount of spending and that amount of hiring may be different than what a CEO might be thinking at the onset. And then capital spending, obviously, this is something that we have to think about depending on, again, the kind of company. A lot more companies these days are going to a less capital intensive model, which is really, really great because we don't want to be spending a lot of money buying a lot of hardware and machinery and things of that nature. So there's more and more now models where even some of the some of the data the data is being stored offsite. We don't need big servers, we don't need data centers and things like that, but it's still something that we obviously have to think through as we're putting together a plan. Okay, so the budgeting, if you look at the nuts and bolts of the actual budget that you put together, there are some things that we need to consider. So things like accrual basis, right? And that is where you got a budget that is based upon actual monthly spending as opposed to just cash. And this is, I think you want to do both. You want to do cash planning, but you also want to do monthly budgeting from an expense standpoint. And the difference between cash and accrual is around a couple of different things. Obviously, capital, right? Capital. If we're purchasing capital, then that's not necessarily going to hit our P&L or our profit and loss or income statement. It's going to hit our balance sheet more. But it's obviously a cash expenditure. And so the differences between what we spend in terms of expenses versus what we spend in cash, we need to capture that. There's other things too, working capital and things of that nature that, again, as you get into the nitty-gritty, differences in working capital assumptions can have an impact on cash. And this kind of goes to Steve's point about, the difference between, being profitable versus cash flow positive. There can be differences, and I've seen, and I think we've all seen as financial executives, situations where companies don't understand their financials because they say, hey, our revenue is growing, our income is growing, or our increase or our loss is decreasing, but it just seems like our cash is just being sucked up and we're running out of cash and we're always running in a cash flow negative situation. Why is that the case? And it's because of things like this. It's because of things like working capital and capital expenditures, and our ability to forecast those properly and then analyze our actuals against those forecasts is critical, not only from a financial modeling perspective, but then going forward as a financial management perspective. And then, of course, all this, if we have different departments, if we have different executives who are managing those different departments, then obviously they're all going to have different inputs. If it's just a CEO or a founder who's putting together kind of a financial plan, then it's a little bit different, but you still have to break out, I think, expenses in two different ways. One is kind of by major cost drivers, so things like salary and sales and marketing and R&D costs and G&A costs. And then you also have to look at it, also have to look at it from a department by department perspective, because that's really going to be the slicing and dicing that each of the executives have to understand about what is being spent in different departments of the company, especially as a company grows and there are changes. So in the beginning, there's going to be obviously a much bigger effort on the R&D side of the business. And then as the company matures and as the product matures, you would expect that sales and marketing is going to take a bigger piece of that. And so if all you're looking at are major cost drivers like salaries and G&A and sales and marketing and R&D, you're not going to capture that, and you're not going to be able to show how the business changes going forward from an R&D perspective to a sales and marketing and hopefully getting to a profitable company perspective. So some of the variables that Steve has already identified, and then obviously the key revenue assumptions, which really should drive all of this. And then the final point is on the running the different scenarios, which is, I think there's two things that can be uh, that are benefits of running different scenarios. One is it makes you look at your assumptions, right? It makes you look at, okay, I've got a revenue assumption and I'm going to run a business model or a financial model based upon these revenue assumptions. And you do a bottoms-up approach and you put together a plan. But then you also have to look at, okay, well, what happens if product development doesn't happen as quickly as I'd like? What happens if we don't actually start getting revenue in 6 months or 9 months like we originally planned, but the product development takes longer and it's going to take 12 to 18 months? What happens to our financial model? And we have to be able to answer those questions because investors are going to ask. And so a lot of companies I know do several things, right? They put together what we would consider to be a realistic and investable plan that is our best guess as to kind of what's going to happen. Putting in assumptions about product development and revenue growth. And then we might put together an optimistic or an operating plan that drives our team towards a higher goal than what our official plan of record or investment plan might be. And then for the purposes of just making sure that we understand kind of the worst case scenario, we would want to put together a plan that says, okay, well, what happens if things take longer than we'd like? What happens if we're not able to hire the key people as quickly or on a timely basis as we like? And what happens to our cash flow? What happens to our revenue model then? And what happens to the amount of money that we have to raise then? And so asking those questions of ourselves and putting that together into different plans, I think is a really, really great management tool, and also enables us to answer the tough questions when those kinds of questions are asked by potential investors. Okay, we're on a budgeting exercise. Okay, so if the company's been around for a while, then we already have a historical set of expenses and revenue that you can look at, and obviously that's a first place to look at. As we trend forward, Steve talked about trending, and from a revenue and cost perspective, I think that having historicals will obviously help. And then kind of getting back to what I think is the key thing that we have to look at is what do we need to accomplish? So what's the next milestone? As Steve mentioned, we're not going to be raising money one time. We're going to be raising money 2-3 times as we progress along our timeline and as we become a successful company. And when you look at the valuation of a company, what we're trying to do is we're trying to maximize the value of every investment that we get. And as we know that the valuation of the company is not linear and it's certainly not a curve. Instead, what it is, it takes big step functions, right? And those step functions and those big increases in the valuation of company happen when we hit milestones, right? And those milestones may be things like product development and the finishing of a product, getting a product to beta or to general availability. It may be a certain number of eyeballs on a website. It may be a certain number of customers. It may be certain revenue targets. And so we need to understand what those milestones are, what the next milestone that we're trying to achieve, and raise enough money, with obviously some buffer in there, raise enough money now to be able to hit that milestone and get that next big jump in valuation before we go out and raise the next set of financials. So, you put a milestone in place. This is the date that I expect to hit this milestone. This is, when I hit that, I know I'm going to get a big increase in valuation. And then this is the financial plan that I need to put together so that I maximize my chances of hitting that milestone with the money that I'm trying to raise. And obviously, those goals, we have to ask the budget owners, we have to ask the executives of the team, what is it going to take to hit that next milestone? How much money do we need? How much time do we need? How much spending do we need? How many employees and what level of employees do we need to hire to make that happen? And that's basically the gist of that, that long-term plan, and hitting those, setting those milestones on our calendar to make sure that we're able to hit them and get that big jump in valuation for the next round of financing. And then, things like trade-offs, that's what's going to happen, because if you ask every executive what is needed, you're obviously going to get an answer that comes back with, well, I want the sun and the stars and the moon. And obviously that's not possible. And so we need to make trade-offs. We need to be able to say, well, we're not going to be able to raise, $6 million or $5 million. We're only going to be able to raise $2. So what do we need to do? Where do we need to cut back? Or what are the things that are critical to achieve? And what do we need to raise in terms of financing to achieve those? So, and then as all those trade-offs are discussed, then we will, as a team, kind of gather around the table and say, yes, we're putting our foot on, we're drawing the line in the sand, that this is what's happening. All the executives buy off, and at that point, then we've got a plan in place. So going to the next slide, which is the top-down projection, and this is just a question of the bottoms up versus the top downs. The bottoms up we discuss. We take a look at what kind of revenue we're going to achieve, and then kind of build up from there in terms of okay, what are the costs that we're going to incur? What's the spending that we're going to have? What's the hiring that we're going to need to be able to achieve those? The top-down projection is something that I think at a high level is useful, to understand kind of what the market size is. And this is where you start with the market size and you identify what's the niche, what is our company's niche, because obviously if it's a big, huge market, we know that when we're starting off, we're not going to get to all of that. But what is that niche? And so what is the market size of that niche we're trying to go after, or the segment that we're trying to go after? And then we say, okay, well, based upon that and based upon kind of what we know we're going to be able to do, we think we're going to be able to capture this much market space in this time frame. And by doing that, then at least you have a ballpark in terms of the revenue size or the revenue potential of the company that then we can use kind of to start the process of the bottoms up. But there's people who think that we can do this kind of a top-down projection, extrapolate a total revenue, kind of put together a revenue plan, and then just kind of put in percentage of that revenue for expenses and for cost of goods sold, and get to a net income. And I would argue that is not an appropriate way of putting together a financial plan, just because it doesn't really hit the drivers and it doesn't answer the critical questions of all the assumptions that we need to be making to be able to for us to give the confidence to be able to say that yes, this is appropriate model that we know that we can hit. And then the final slide is reforecasting, and Steve mentioned upon this as well. First of all, don't do a 5-year plan. Do a 3-year plan. I think that's what most investors are looking for. 5 years is not that well. I mean, obviously, we kind of want to understand where we think we're going to go, but from a financial modeling perspective, I think a 3-year plan is appropriate. We want to update our budget and on a quarterly basis for 2 reasons. One is to just, again, validate that the assumptions that we've been making are accurate, that the spending plans that we have are practical and realistic, and that if we start deviating from those plans, we see that at least on a quarterly basis, because we'll be wanting to have discussions within the executive team and maybe to our investors when things are not going to plan. The last thing we want is a big surprise 9-12 months after the fact to say, oops, we didn't make our plans and it looks like we're going to need more money than we planned. And obviously that's a message, that's a hard message, and we want to make sure that we're not hitting that before we actually get to it. And then for investors, I think they would love to see a quarterly plan for the first year and then annually after that. I think from a preparation of the plan, however, I think that that doing all this on a monthly basis for 3 years is probably the most accurate way of doing it. And then we just kind of roll that into a quarterly and annual plan for presentation to investors. And I think that is kind of the I think the high level of both what we want to to think about as we're getting ready to do a plan, as well as a lot of the factors that we want to look at, as we're putting this plan together. Um, and I think that's it for the presentation. Jenna, are there questions from the team that we want to address?
We do have one or a couple questions from the audience coming in. What is, or is there like a best practice in terms of creating your financial plan?
Um, well, I think I'm not so sure about the best practice. I mean, I think we could say that you want to put together, like I said, a monthly plan that rolls into a quarterly and annual. You want to put together not just a spending plan, but you want to put together a pro forma a balance sheet and a cash flow statement, because those will hit upon the differences between the actual expenses being incurred and the actual cash that is being used by the company. And so you want to have both of those things. But other than that, I think just using all of those, kind of doing the bottoms up approach, and each company in each industry, what the plan is going to look like is going to be a little bit different.
And then is there a good way of uniting the top down and bottom up approach for building your financials?
Yeah, I think there is, and I think that that's kind of what you do is you say, okay, you start with a tops down, and you kind of look at the market size, market potential, the segment, and then based upon kind of what we bring to the table in terms of our expertise or our secret sauce, what kind of market share that we can expect to get, right? And so you do a timeline of that. You see the market size exploding, or you see the growth. You have industry data that suggests that this market size is going to be this high in 2-3 years out. And based upon that, you kind of extrapolate down based upon the percentage of the market that we expect to get of the segment that we're going to be in, what our top-down revenue is going to be. And then you use that as kind of the basis to start, on the bottoms-up approach, which is, okay, this is the revenue plan. Maybe we make some tweaks to it. Maybe we be a little bit more conservative than what our tops down is going to be, or maybe we're more aggressive because we think that we are just going to be such kick ass in terms of what we bring to the table, or the new thing that we're bringing to the table, and we think that the market is really going to take hold of that, and so we're going to be more successful. And you take that revenue and then you use that as kind of the basis to say, okay, these are the revenue projections, top-down revenue projections, which kind of starts our bottoms up. But now is the hard work of saying, okay, these are the milestones that we have to hit these revenue projections, and then this is the staffing we need, this is the spending that we need to incur, and then these are all the assumptions and all the cash that we're going to need to generate that kind of revenue.
Perfect. And then how would we best support the bottom-up financial projections with client names, prospects, et cetera?
Well, I guess this would probably be a little bit more specific to each company, depending on kind of the status of the company. So, if a company is already in a revenue state, and now it's about kind of revenue growth. If it's a company that is that sells let's say it's an enterprise software sale, and so they're selling big pieces of software to big customers, and the number of customers that they have is limited, and can actually be counted, and you can actually say we're going to be going after Fortune 100 or Fortune 500 companies. Then you might have one way of being able to say this is how we're going to grow our customer base. If it's a company that is more of a business to consumer company that's going to have tens of thousands of customers, then it may be a different type of criteria that you would use to be able to back up your revenue projections. So I think this is kind of different for each company and different for each industry. And again, you have to as an executive team, you have to kind of get around the table and work out those questions directly, individually for each company, and put it down on paper. But ultimately, you are going to want to put down in your list of assumptions, basically how you're going to go after this market, what percentage of the market you're going to get, and the reason why you think that you're going to be successful in hitting those numbers.
Perfect. What is an inputted hurdle rate that seed investors under $1 million are looking for in a financial plan? And how do we best stage this? Plan for high return with buffer for realistic results, probability weighted scenarios?
Jenna, I'm sorry, could you repeat that first part of the question again?
Yeah, what is the inputted hurdle rate, or the IRR, that seed investors are looking for in a financial plan?
Um, well, I'm not sure that there is a particular one. Again, I think it's gonna, a lot of it is going to depend, on the type of business it is. Obviously, what you're looking for is you're looking for big increases in valuation. I'm not so sure that there is a specific IRR that every individual investor is looking for at the seed financing versus a Series A. Steve, do you have any input on that?
Yeah, it really depends. I think it depends on the investor. It depends on the business model and the market. At the very early stage, investors are looking at. They're really going to be looking at your revenue growth potential, and they're really going to be valuing you based on their expectations around your market size and your revenue potential. So, again, at the early stage, it's a lot of art as opposed to science. So, I think that the point to that is, if you're raising money, you're going to want to present a 3-year plan that shows, probably shows some significant revenue gains by the 3rd year, right? Because that's going to have the biggest impact on the evaluation and the investor's return. Whether or not you make money in those 3 years or don't get cash flow positive until the end, as long as you understand that and you model it, they're really going to be paying attention more to your revenue potential than anything else. If you're growing from a revenue perspective, you can pretty much always raise
money. What if you don't have a full exec team as an early startup?
Yeah.
Go ahead, sir.
Well, yeah, and I think that that's going to be the typical case, right? Depending on the stage, a lot of companies are looking for either that seed or Series A financing. It may be just one person who's kind of handling the product development and looking at what they want to be doing from a product development and marketing standpoint and market positioning standpoint. And there, I would say, you have to try to put on multiple hats, and you have to say, okay, well, this is kind of what I expect to do. I know I need to develop product. Am I going to be bringing? Am I the technical person? Do I need to just bring a couple of high-level senior engineers or programmers? Am I the business person? Am I going to need to hire a founder or a founder level, CTO level person? So first that has to be answered, and then I think you have to kind of take a best stab, and I would also say that this is probably where having some advisors, some other folks that in your network that can help you. Would be able to assist. If you're more of the kind of the conceptual guy and you have this great idea for a business, make friends or talk with your engineer friends to talk about kind of what would it take to get this thing done, and have them assist you. Definitely have someone on that can help you put together the model too, to be able to a lot of us finance folks we've been with a lot of companies. We've seen a lot of early stage companies. We can, help you also kind of, model some of that stuff out and at least ask the questions about, well, have you considered this? Have you considered this? In our history, we've seen a lot of companies, that did it this way. But definitely bring in outsiders, who you trust, to help you with this process.
Yes, solicit advice, especially in areas where you're not uh, you don't have a really solid understanding of the operating mechanics. As an example, building a model for enterprise SaaS company, actually, at a very early stage. So it was basically two founders building a model, and they didn't have a whole lot of expertise around IT infrastructure, right? So the hosting component in a SaaS model is very significant, and depending on what you're doing, what you're delivering as a service, it, it, it could have major implications to your planning and your costs. And in that particular case, they went outside to an expert and said, how do we think about this? How do I need to think about this, from an infrastructure perspective and a cost perspective? Um, and that expert came back with a pretty detailed and complex modeling solution, but it was relevant and it was accurate, in the sense that he flushed out several different cost elements and tiered cost elements in that particular case, where you have a particular cost that's at one level until you hit a particular volume, and then it jumps to a significantly higher level. So anyways, the point of that is solicit input from experts and advisors.
And especially for a lot of the technical guys out there, who have an idea and know how to get it done from a programming perspective, definitely seek the advice of sales and marketing and business folks that because I've seen that kind of happen too, where CEOs and founders think that hey, I think we're gonna need this kind of spending from a sales and marketing perspective, and then when you really talk with someone who kind of understands that space and understands what it's going to take to be successful, it's a different level of magnitude, and so making sure that we understand that as CEOs, so that we don't look foolish when we're presenting a financial plan to investors is critical.
Perfect. I think we have time to answer one more question, and then any additional questions we'll answer via email after the presentation. So what if a business is a new startup, and what format or plan type is best used for projections?
Go ahead, Steve.
All right. There isn't a particular format. I think to the point we've been making, a 3-year plan, right, that has detail down to the month and it rolls up to an annual picture, with a full set of projected financial statements, income statement, balance sheet, cash flow. That's the detail behind that can be quite extensive, and the reality is your investors may look at that, they may drill down on it, but they want you to talk about it, and they want to be comfortable that you understand down to the lowest level of detail your financial model. But in terms of a particular approach or format, it's really not about that. It's about providing the elements, right? You don't need to go 5-year, just focus on 3-year. But also try and develop, your full set of projected financial statements. More often than not, if what I see is startup founders that are developing the plan themselves, they really focus on income statement, right? They focus on revenue and spending, right? And they completely ignore the balance sheet implications, and the big drivers of cash fluctuation in your business that exist on the balance sheet are accounts receivable on accounts payable, um, any other cost accruals that you might have, like you might pay, you don't pay commissions for 3 months or 6 months. Um, and in software as a service, you have a huge component of prepaid services that don't show up in revenue, but you get cash up front. So it's a huge cash advantage. And those elements are all balance sheet. You're not going to, you can't model that from a P&L model. So be aware of those things. And again, the more, when you do present the full set of statements, you're presenting a level of, you know, you're presenting a level of financial expertise that the investor will appreciate because you're considering all of these other pieces rather than just the P&L.
Perfect. It looks like we are all out of time for today. We'll go ahead and follow up via email for any questions that are left unanswered. Also, feel free to email Sirk, Steve, or myself with any additional questions that come up. And the slides are available on SlideShare, and the video of this presentation will be available on YouTube this afternoon. Thank you, and everyone have a great day.
Thank you, everyone.
Thanks.